What's up everyone, it's Karthik with MoneyVest. So by the time I was working to record on this video, the markets actually took a bit of a dump and volatility is higher, a little bit over 7.5% right now. And we do have, of course, individual stocks and indices. I mean, NASDAQ 100 just absolutely selling off, down almost 1%, with the S&P 500 also taking a bit of a dump here, down almost 0.5% at the moment. But that's not the point of today's video. I really wanted to come out and bring you some education in this video, and today we're going to be talking about the red zone, because I've been asked a lot of times a lot of these questions that I'm down 70% on a stock or 90% on a stock or 40% on a stock. What should I do? So this is going to be a video for pretty much all investors out there that have been investing in individual stocks or even ETFs or indices. Doesn't matter. If you are investing, you understand that this game comes with risk, and that risk is the potential for loss. The potential for loss will always be there. So I really want you to share this video with other traders, investors, friends, family members, and it really is recommendations like this that help us grow our channel. So I would really appreciate that. I'm super grateful for all of you. And drop a like if you enjoyed this video and find it helpful. So the red zone is nothing but the idea of being red on a stock. Nothing more, nothing less, right? So you are in red the moment a stock dips below your cost basis, and you are in the red zone, as I like to call it. This is not an official term. You can't just Google it, but I like to call it the red zone because you'd be down anywhere from over 30 to over 50% on a particular stock. So the red zone is when the stock dips below your cost basis by more than 30%, and a deep red zone is when the stock dips below your cost basis by more than 50%. So in other words, you're down anywhere from 30 to 50, as much as 70, 80, 90%. The numbers are pretty much significant here. Now, the reason why this is so important is because, number one, and I want to preface by saying this, that this is the risk that we take for investing in the markets, okay? The biggest risk that you can potentially have is the loss of capital. That's pretty much the only risk, right? So if you're investing in the market, if you're investing in individual stocks, the biggest risk that you have is that you can end up losing your entire investment and the money is going to be gone, right? Because the company is no longer going to be there. And that's what we're going to tackle in this video, on how to approach investing in the market so that you preserve capital. Because at the end of the day, capital preservation is very, very underrated. As Warren Buffett's two famous rules go something like, rule number one, never lose money. Rule number two, never forget rule number one. So his idea has always been around capital preservation. You need to preserve capital in a way that you stay in the game long enough for when the odds are in your favor and you're able to take advantage of long-term success, because markets and investing is all about staying in the game. Half the battle is staying in the game and not losing your capital. So that's the red zone. And if you scroll further, and you might be asking yourself that there's been instances where I've been down on a stock. Isn't that a buying opportunity? Isn't you're supposed to buy when you're down? Like when you're seeing red, when you are down significantly on a stock or the overall index or ETF, isn't that a signal to buy? Because we're trained, we're always trained to buy the fear or buy the panic, buy the selling pressure, right? Isn't that supposed to be the case? And you'd be right, because Warren Buffett has mentioned when stocks go down, it's good news. So a lot of this advice from Warren Buffett, when stocks go down, it's good news. It's good news for him because, once again, he's able to evaluate individual stocks that are very, very high quality, and for where the price is trading below the value. Howard Marks teaches us the same exact thing, right? Prices often become disconnected from fundamental value. So value investors recognize that the securities that they buy are not just pieces of paper, but rather ownership stakes and in an actual business. And these financial instruments have fundamental worth, and it can be quite different from the price quoted in the market. So price and value are two very different things. We've talked about this in our courses and in our previous videos as well, that price is what you pay, value is what you get. Price is the stock price, value is the fundamental value of the business itself. And where there is a discrepancy, that's where dislocations happen. Price can be trading significantly higher than the value of the business. That's overvalued. Price can be trading significantly lower than the value of the business. That is undervalued. And there's also disguises, right? There's also companies that may be a disguise, meaning a value may seem like it's really high and the price is really low. So there's a discrepancy there. The stock price may seem like it's undervalued, when in reality, it can be misinterpreted or it can be misevaluated by individual investors like ourselves. Now, I want to be very clear. Like, it's not like I'm perfect in picking stocks. In fact, far from that sort of a 100% win rate. So, I've had many wrong calls in the past. Neo, TrueLeave, Walgreens are some of the examples where I did not evaluate the business well, and as a result, that resulted in a pretty big loss for myself. And that's just how it is, right? You're not going to win every single time. You're not going to get every single stock correct in your analysis. And that's why it is really important for us to do these regular evaluations of the stocks that we're picking and putting into our own portfolio. That's how you construct an active portfolio of individual stocks that you're always coming back to revisit the story every few quarters, especially if the stock price is volatile and it's fluctuating. So what I've done is I've broken it down into very simple terms. So what moves a stock is essentially story plus numbers. Okay, this is actually covered in a lot more detail in our fundamental analysis course, but the story of the business and the numbers of the business combined is what makes up the entire proposition or thesis for a company, for an investment. Story can be kind of encapsulated in qualitative analysis, and numbers can be encapsulated in quantitative analysis. A story is quite literally what it sounds like. It's a story of the business, right? What's the management like? What's their product? What's their service? How are they serving the future? How are they helping people? How are they helping businesses? What's the overall story that they're trying to tell us? And numbers are the actual facts. These are the quantitative numbers. You can actually quantify them, like revenue, cash flows, valuation, profit, balance sheet items like debt, cash, all those things. So story and numbers is what moves a stock. And the discrepancy, again, can be found in those two things. An unrealized loss, or any loss for that matter, happens when there has been a disconnect or misevaluation of either the story or the numbers or both. Okay? So oftentimes if you go back to a stock that you picked or that you invested in that you may be down on, you kind of look back, and we're going to go over my checklist here in just a minute, but if you go back and look at that and try to understand like what exactly went wrong, what was the disconnect, it can fall in one of those two categories. It's either the story that you didn't get right, like for example, PayPal's story was under a lot of pressure for me personally. The numbers were good, the numbers were solid, but it's the story, it's the qualitative analysis that I wasn't able to anticipate at the time, and as a result, it dropped 30 to 40% from its all-time, from when I bought it, right? So I'm down almost 40% on PayPal. That was a disconnect in the story of the overall business. The numbers were solid. The numbers are still to this day pretty strong, but it's the story that did not quite pan out as what I was expecting, 2 years ago. So that's the disconnect, or that's the misevaluation on my part of not being able to fully identify or understand the story of the business. Now, that is also the harder part. Story is, or qualitative analysis is more challenging to evaluate than the numbers, because what happens is story moves first, numbers follow. Always remember that. Story moves first, numbers follow. So qualitative moves first, quantitative follows. NVIDIA, before it even had these amazing numbers, NVIDIA had a story. It had an amazing story. It was telling us an incredible story of the future with AI. And then the numbers followed. Numbers are nothing but a validation of what we already think we know. Okay, so investors may already think that we know about the story. Numbers are nothing but a validation of that story. And if the numbers come in better than what the story was, that's a beat on expectations. And if the numbers come in worse than what the story was, then that is a miss on expectations. So qualitative analysis moves first, numbers follow, or quantitative analysis follows. And that's why qualitative analysis is also one of the hardest things to evaluate, because it's intangible, right? You can't really know what the story is going to look like for that company. Take Tesla, for example, right? Tesla's numbers are one thing. Deliveries are strong. Revenues are coming in strong. Margins have been strong. But what's the story, right? It's a story of AI. It's a story of technology. It's a story of full self-driving. It's a story of just a regular auto manufacturer. It's a story of robotics. So what's the story, right? And that's where it's very, very difficult to evaluate what's the overall qualitative analysis of the business. And that's where the disconnect can come from. So that's what moves a stock, and that's what can get you in a potential unrealized loss. That is a disconnect or a misevaluation of either the story or the numbers or both. Numbers can be learned. as you already know, numbers can certainly be learned. You can, take a course and, understand how to evaluate a company's balance sheet and, overall growth metrics and calculate the fair value. Like, the numbers can be learned and you can understand equity research, but the story comes from within. Story quite literally comes from a gut feeling. It comes from your understanding of the business and the future and everything around you. And that's when it becomes a little bit more person to person, investor to investor, and how they see the story of the business for the long term. So this right here is what I have. And the reason why it is so important to avoid massive losses, bigger losses, is because it becomes that much difficult to recover. So what I have here is the loss percentage and the percentage needed to gain to get back up to break even. So for example, if you are down over 5% on any stock, it's going to take you just over 5% to recover what you have lost, right? On an unrealized basis. So that is a number just to get to break even. If you're down over 10% on a stock, it's going to take you just over 11% to get back to normal, get back to break even. So those are some pretty normal occurrences, right? I mean, if you're buying a stock, chances are you're going to be down 5-10% on that position just because of market fluctuations, just because of a regular stock's volatility. So that's pretty normal, and that is expected, right? If you're investing in individual stocks, that is a risk that you are taking on, that you're going to be down 5, 10, 15, 20%. Even up till 20% is pretty normal for us to be down on a stock. And that is a normal correction. But take a look at what happens when numbers get bigger and bigger. It becomes even more difficult to break even on a stock. So if you're down 25%, now it takes over 33% to recover on that stock just to break even. And, it's a simple math problem, but if you ask somebody a simple question, if you're down 20% on a stock, how much does it need to go up in order for you to break even and get back to where you were? Chances are most people will say 20%, right? If they have no idea of how math works, they'll say 20%. But the idea is if you do the calculation, it takes significantly more effort and more momentum to get back to break even. That's why it is so important to really not breach a certain threshold, and that is 30%. 30%. The moment you cross over 30%, and ideally over 50%, is when you're putting yourself in a significant, disadvantage. You're putting yourself behind the 8 ball, where it's going to become very, very difficult, right? To recoup that entire position, just to salvage anything out of that position. I've been in that position, quite a few times, like Neo, Walgreens, and I'll go over what I ended up doing, but that's a position that you want to avoid at all cost. And I'll go over, how you can kind of approach, before you even get there, how you can approach that position moving forward. But again, if you take a look at 30% down, now you need to recover 42%. If you're down 40% on a stock, you need to go up over 66% for that company just to break even on that position. And this is not including for dollar cost average, right? So I want to be very clear. We're just keeping things constant. You're not buying any more stock. You just bought it and held on to it. And then you're down 50%. And now the stock practically needs to double in order for it to go back to break even from where you bought it, right? 100% increase, it needs to do that in order to break even. And these numbers only get worse. 60%. The stock needs to go up 150%. If you're down 75% on any investment, the investment needs to go up by 300% just for it to get back to where it was, where you originally bought it. And as you can imagine, 80%, that's 400%, 90%, it's 900%. And if you're down 95% on a stock, I mean, that's practically worthless, and it is now required to go up by over 1,900%, so 1,900% gain needed in order for that stock to break even, just from where you first bought it. And the interesting thing is the stock can always fall 50%. Always. Doesn't matter if it's already down 90% from its all-time highs. From that point on, it can still get cut in half and still drop 50%. Just how math works, right? So the idea that I'm trying to make here is that you want to really sort of set thresholds where you put in more and more time to try to understand the overall story and the numbers of the business, so you don't fall into a situation where you're down 40%, 50% on a position, and then you're trying to salvage or recoup whatever it is that you lost, because then it's already a lost game, and there's not much that you can actually do. So if you are down 5 to 10%, I think that's pretty normal. The story, the number stays intact. 5-10% is normal market fluctuations, so no intervention needed. 15 to 20% if you're down on that stock, then I think it really is a correction. And then you need to ask yourself, was that with the market? It really, I mean, it all boils down to whether that sell-off was with the market or without the market. Because if it was with the market, you can make a case that, okay, pretty much everything sold off. Like, for example, Monday, August 5th that we just experienced, the entire market was selling off, right? There wasn't anything specific to any stock. You can make a case that Google had a catalyst, Microsoft had a catalyst, but in general, every single stock, every single company was selling off. So the sell-off was with the market. So if the answer is yes, right? If it's with the market, then I think it's really important for us to look at the percentages. Like, was it underperforming, overperforming the market, or outperforming the market? And if the sell-off was greater than the market, so for example, if markets were down, let's say 5% and the stock ended up down 20%, then it certainly was with the market, but not at the same magnitude. So I think it still requires us to recheck, revisit the story and the numbers, right? Just go back, check the numbers, what actually happened, why did it sell off? And if it doesn't affect the story, if it doesn't affect the numbers that you originally had for the thesis for the company, then I think it makes sense to dollar cost average. Because like I said, when stocks go down, it's good news. It's good news for high quality businesses that the story and the numbers remain intact. If they are changing, that's when I think the narrative needs to change, the thesis needs to change, and there has to be some proactive decision making that you need to do. If there was a sell-off without the markets didn't really do anything and the stock was down, then you need to really dig in and ask yourself why. Like, why did that happen, right? What was the catalyst? What was the overall news? What really happened with the company that resulted in a 15 to 20% drawdown from when you first originally bought it, right? Now, this could be because of unrelated reasons. I mean, it could be also because the markets were extremely overbought, or that stock was technically overbought and it was due for a correction. So that's also normal. But in that case, you also have to understand where to buy it, right? So buy price also comes into play because you have to have an understanding of fair values. You also have to understand, where the company's fundamentals put that fair value for the company, where the technicals are with respect to overbought, oversold conditions. So if you're buying at pretty good levels with good margin of safety, and then it drops 20%, that's when this analysis comes in, right? So if it's selling off without the market selling off, then again, you have to ask yourself why. Why is that happening? And it's really just the same process following over and over again. Peter Lynch has talked about this over multiple times in his books and in the past, is that you have to constantly revisit individual stocks. If you're investing actively in individual stocks, you have to revisit their story. You have to come back every quarter, every few months, take a look at their story, take a look at their numbers, and if it's still aligned with your original process, with your original thesis. And if it is, then nothing really changes, right? Nothing really changes. They're still on track to doing really well, story-wise and numbers-wise. And so nothing really changes. So that means that you can continue to be more confident and build your conviction level in that company. But if something changes, if there's a change in management, if there's a change in overall philosophy of the business, the culture, the product, the service, the customer base, all right? So different things can happen that can result in a change or a shift in overall narrative, then I think it's really important to ask the why. You have to constantly revisit the story and ask the why. Why is the story changing, or why are the numbers changing? Why is the stock price down 20, 30, 40%? Because the sooner you do that, the better protected you're going to be from an eventual 50, 60, 70, 80% sell-off. So, at any point in your investment, I think this is a moment that you really want to avoid. You just don't want to be down over 75, 80% on a stock and then come back to it and be like, wow, wish I had paid attention earlier to figure out what was going on so that I wasn't going to be down 75, 80%, because this is an unsalvageable position. I mean, for the stock to go up 300% is not that easy, right? So you really want to avoid this catastrophe where you're down so much and then you're doing an evaluation at that point. So you really want to sort of set those thresholds earlier and revisit the story, revisit the numbers to better figure out what is going on, why is it down, and does my story, my numbers still align with my original thesis? And if the answer is yes, then that's a dollar cost averaging opportunity. If the answer is no, then you can kind of evaluate, okay, do I need to get rid of it to put that money into something else? Or should I just wait and see how things play out? Again, it's a question and answer process with yourself, right? That's what you're trying to do. And this is my message for today in this video. And that is being wrong is an accident, but staying wrong is a choice. So it's very important to admit when you're wrong. I was wrong on Walgreens. I was wrong on Neo. I was wrong on TrueLeave. I was wrong on PayPal. At least that's what it looks like up until now. But staying wrong is a choice. I sold all of them, and then I ended up picking more individual stocks like Nvidia, Tesla, SMH, VUG, IWM, and I've made money, right? So I've made money, not only what I lost on them, but more. So being wrong is an accident. You got to learn from it and then move on. Staying wrong is a choice. So you don't need to recover your loss from the same stock you lost it from. So no need to beat a dead horse. So if it's not a high quality company anymore, if you don't believe in the company anymore, it's okay to throw in the towel, take the loss, move on into something that you feel has higher quality. Okay? So that's all I've got for you today. Hope you all enjoyed this video, found it helpful. If you did, make sure to drop a like. Let me know your thoughts down in the comment section below and what you actually think about this overall lesson. And as always, happy investing. I'll see you all in the next video.